not sell, right? Some of those could turn into foreclosures. They could be short sales if people have to sell and relocate and do whatever. There's an opportunity for seller financing though. So there's so many different things depending on your time horizon that you should be thinking of. And I say all of that to say this and go back to the original point of now is not a risky time to invest. The risky time was a year ago when we didn't know where the peak was. Well, guess what? Now we know where the peak was.
Welcome to another episode of The Financially Free Investor, where you will learn information and strategies on how to become financially independent by investing in real estate, something that is not taught openly in our society today. Financial freedom matters so you can live a bigger life, retire early, and do what matters most to you. Get ready to hear tried and true methods to becoming financially free with your host, Jordy Clark.
What's up, everyone? Welcome to another episode of the Financially Free Investor podcast. So today I'm recording this March 1st, 2023, and we'll probably release this as a special episode. I've got some awesome guests lined up. I think you guys are going to get a ton of value of them coming up. Hopefully you've gotten a ton of value out of everyone so far, but here is what I wanted to talk about today. Today is March 1st, 2023. Interest rates are going crazy. They're super high. The real estate market in Salt Lake City, Utah, well, in Utah in general, and a lot of very expensive areas that saw lots of appreciation over the last few years, is down in volume, down in price. There's just so much going on. It's kind of a weird market. Buyers are hesitant. There's a lot going on, right? A lot of people have kind of been saying the same thing. We think this is 2008 all over again. And I wanted to address that in this podcast. I'm not going to get totally into the weeds on everything, but just give you some thoughts and, what's going on and how it's different, because it is different than 2008. The other thing I wanted to address, and I'll start with this, is, a lot of people, we're heading into a recession. We're probably already in a recession. A lot of people are hesitant to invest. They're hesitant to spend money right now. And I want to dispel that myth that right now is the time to invest. Right now is the time to go all in. Right now is the time to move closer to financial freedom for the reasons that I'm about to spell out here. The number one reason is it is not risky right now to invest because we know where the housing market price peak was. Again, at least talking here in Utah, I think a lot of areas are going to be very similar. So, I mean, looking at the data, at least here in Salt Lake and Utah counties, now this isn't the same for Summit County, which that's where Park City is at. They're just a different market. But at least right here, we can see that the peak of the market as far as home pricing goes was last April and May. You were still seeing bidding wars. People were going way over. Around June, it started to slow down. July, it started to slow down even more. And funny enough, I actually bought my personal residence at the peak of the market. And, I think we're down maybe 10% from the peak, at least in our area, which I don't really care about it because I'm okay with our payment. I'm okay with where we're at. And, in 10 years, I think this is going to be a no-brainer knowing what I know now about who's coming into the state, the land we have left, what other things are going on. I mean, I'm literally 5 minutes away from a brand new primary children's hospital that's going to be completed next year, which it's going to be just huge, guys. So with that being said, there's tons going on, tons of stuff. And so it's the most dangerous time to invest was April of May of last year because you still had the euphoria. You didn't know where the peak of the market was. People were overpaying by $50,000 to $100,000 on properties. And, granted, they probably still got decent rates, but they overpaid. Here's a great example. Townhouse. We had a client buy a townhouse, paid, we'll call it $525,000. He was under contract for 9 months before it closed. Then interest rates started going up. There were some people that started backing out. And this builder was releasing these townhomes at $550, so well above already what people who had locked in 9 months ago paid. And then cash investors were coming in and they were bidding them up to $590, $600, $610,000. And it was crazy. And when I started seeing people backing out and just like nervousness in the market, I was like, man, I don't know about this, right? And true enough, it was the peak of the market. So those same townhouses today, if you root around, there's pricing all over the place. You can get them as cheap as $415, $420. And, there's some sellers that are still optimistically holding out for $500, $525. And they'll never get those prices because the builders are currently selling them for $425. So almost $100,000 discount from what these other sellers are up in the night about. And they're just going to not sell, right? Some of those could turn into foreclosures. They could be short sales if people have to sell and relocate and do whatever. There's an opportunity for seller financing, though. So there's so many different things depending on your time horizon that you should be thinking of. And I say all of that to say this and go back to the original point of now is not a risky time to invest. The risky time was a year ago when we didn't know where the peak was. Well, guess what? Now we know where the peak was. And as I'm underwriting flips and we're underwriting rental properties, I am fully forecasting that we will continue to decline in price by 1% per month. That's 12% per year. Now, I do that because what happens if I think home prices are going to be flat in 6 months and I go to flip a property? And I underwrite it at what that sale price will be, and it goes down, well, guess what? There goes all my margin and I'm going to lose. But if I underwrite it and say, okay, things are selling for $450 for this type of house in this type of area, and I think 1% a month, that's $4,500. I think I'm going to hang on to this for 6 months. You can just do the math onto what it could potentially be worth in 6 months when you go to sell it, right? Here's the key though. If you buy something and get good debt on it, and you plan on hanging on to it for 10 years, we're going to ride out whatever this is, right? However long this market lasts, you're going to ride it out. You're going to stick a tenant in it. You're going to forget about it. Your property manager is going to manage it. It's going to do its thing. It's going to get paid down. It's going to go up in value just as our dollar gets debased and goes down in value. Real estate's a natural hedge against that inflation. And it's just going to seem like magic. And you're like, oh man, I'm so glad I bought. And I didn't listen to all the fear-mongering in the news right now, right? The best, I would say arguably the best time in the last 20 years to buy real estate was in 2009 when everyone was scared. Well, guess what? So many people are scared right now. This time is different though. I started out by saying that, and here's how it's different. Leading up to 2008, you could basically go and fog a mirror, meaning like imagine somebody standing in front of a mirror. How do you fog it? You breathe, right? And that fogs the mirror up. So if you're breathing, banks are giving you loans. You could say, hey, I make 50 grand a month when you make 5 grand a month, when you make $5 a month. And the bank would go, okay, well, they said they're making 50,000 a month. Here you go. Here's your $10 million loan or whatever it was, right? And if you watch the movie The Big Short, it goes into how, some people who worked on tips, they were going and buying second, third, fourth, fifth houses, and they were all sitting vacant, right? And there was just no underlying fundamentals of what was going on because everyone was buying based on speculation and based on prices continuing to go up, right? So that is the same. There was a lot of people buying on speculation that housing prices were never going to go down. I even remember realtors in 2021 and 22 saying house prices will never go down. And I was like, you guys are retarded. They absolutely can go down. And sure enough, we saw interest rates get raised at the fastest period in 30 or 40 years. And we saw house prices stall. We saw house sales stall. But here's the difference. For the last 5 years, they didn't have any of those ninja loans. No income, no job, no assets, and they give you the loan still. None of that's been going on. You've had to fully qualify for everything you get a loan on. Now, there's some like DSCR loans and stated income loans still. But like for the most part, almost everything was like a full doc loan, meaning you had to prove that you could qualify and to repay it. So like they're all really good loans. And after COVID, we saw the lowest interest rates I think we will probably ever see in our lifetime. And there was an 18-month window period where, I saw people getting loans at 2%, 1.9% for a VA loan. I have a really good friend who bought a multi-million-dollar house, put zero down because of his VA benefits, which good for him and thank you for your service. But like 2%, his mortgage, that mortgage payment is more important to him than arguably the house, because you can adjust and you can modify and you can paint and you can do all these other things inside the walls of the house. But people buy houses based on payments. And he is never, I can promise you, he is never letting that payment go, at least for the foreseeable 10, 15, 20 years, right? So because of that interest rate. Now there will get to a point in time where life will change and people will let that interest rate go, especially as you make more and your career progresses or whatnot. But I read a statistic. It's something like 80% of loans in existence right now are less than 4% interest. And if you look back the last 70 years and average all the highs, all the lows, the last 70 years, so call it 1940 to 2022, the average interest rate on a home mortgage was like 6.9 or 7.1%. And that's about what they are today. There's some volatility and they fluctuate and a lot of different things. But for the most part, they're right in that range of a 70-year average, right? So not super high, not super low, just average. But we have so many loans and so many people that I talk to, their interest rate's 3%. Their interest rate's 3.5%. Their interest rate's 4%. Heck, I have some rental properties at 3.125%, at 4%. And they're cash flowing really well because the interest rates were so low, rents have risen. So there's just so many of those little factors that I don't think people will move. In fact, I think we have so many people coming in to our country right now, politics aside, good, bad, and different, I don't think you can argue we have a massive influx of immigration right now. And we're in a housing shortage. And we've got all of these people with super low interest rates and they love the payment and maybe they want to move, but they're not going to because they don't want to quadruple their house payment just to double the size of house they're in. There's just this housing shortage, and builders, by the way, are super hesitant to go and build any spec homes right now because of 2008, because of what happened. But we need the inventory. So I think what we're going to see is we're going to start seeing a lot more, especially here along the Wasatch Front, where we have not a ton of areas. And this is why I'm super bullish on the Salt Lake City area, because we're almost out of land. A couple of years ago, there was a study done, and it was like less than 2 decades worth of developable land left in Salt Lake and Utah counties, because we've got massive mountain ranges, massive lakes, and there's just nowhere for us to build. And I say all of that to set this up to, guys, I think this is a once in a decade opportunity. I'm going to say that again. I think this is a once in a decade opportunity to find really good deals when most other people are frightened. Most other people are not buying. Banks are tightening up a little bit, and it's harder to get loans. They're scrutinizing income a little bit more. And I just think that this is a phenomenal opportunity, and it's not going to be like market wide, but we've seen prices come down, which is good. They kind of had to because they were getting a little ridiculous. I think we're going to see a stabilization, and then I think we're going to continue to see some modest appreciation over the next few years. And so now is a great time to find a motivated seller. And here's the deal. When you're buying one house a year, 2, 3, 4 houses a year, even if you were buying 20 houses a year, you can only buy so many houses per year. And so you're not just going to go out there and buy whatever, right? No, you're going to look for the really good deals. You're going to look for the cream of the crop. You're going to look for that motivated seller who just got divorced and, they're willing to let you take over payments on their 2.5% interest rate. And you put down $10,000 and you own and control the house. And because they're done, right? You're going to be able to find that foreclosure opportunity when everyone else is scared and waiting on the sidelines. You're going to be able to find those really good deals, that builder that's oversupplied on inventory and they're not releasing inventory onto the market, even though the house is fully built and standing there, because they don't want another 2008. You're going to be able to go to them and negotiate really good deals. So, I mean, if this is resonating with you, I think you should go out and take action. If you're not in a place where you could go out and take action on your own, but you're an accredited investor, we're actually opening up for a limited time this opportunity. We're launching a growth fund. There will be more details about it soon. But we're launching this growth fund for accredited investors where I'm going to go out and buy as many of these deals as we can. I'm going to go negotiate with these builders that I know have inventory, and we're going to get super good deals in a growth market. And, I'm talking 20% below market value, below today's market value, right? Like some of the foreclosure opportunities I'm seeing are 20 to 30% below market value. All you have to go in is fix up, paint, do some slight modifications, then we'll put a tenant in there and it's going to rent super well. And it's going to be a once in a decade opportunity. And accredited investors, I'm sorry if you're not an accredited investor, you can't invest alongside us. And this is not an offering, by the way. This is, I'm just saying what we've got coming up. If you want to be added to our accredited investor deals list, and you want passive income opportunities and you want to come alongside us and invest, please text INVEST to me at area code 435-699-3016, and someone from our Silicon Slopes Capital Partners team will reach out. And you'll have to go through the verification process to be, to just verify you're an accredited investor. But if you want to invest in the Salt Lake City market and just don't know how, don't know where, don't have the connections or expertise, we would love to be able to help you out. And this is kind of how we've been able to figure out how we can help those types of people. Everyone else, I'm happy to have a phone call and try to figure out how you can also take advantage of this market. So all of that leads up to we've got this window. And I'm not sure how big the window is. I'm not sure what that's going to look like. My crystal ball is broken. Here's what I know. The peak of the market, as far as pricing is concerned, was almost 12 months ago. We are well behind that. I've got enough data to feel very comfortable about that. And as we're on our way down, again, due to all of the factors, the constraints that I've set up before, I don't know if we're going to stabilize, if we're going to pick up in the spring and start appreciating again. I do know, based on the Federal Housing Finance Agency's data of Utah over the last 30 years, we have an average appreciation rate of 7%, which is better than most of the nation. So we're going to be able to tap into that, and not only are we buying things below market value today, but we're going to be able to exit and sell those at a retail price based on 7% appreciation. So we're really, in most cases, beating inflation by a lot on these deals. And that's the power of 1 or 2 or 3 single family homes, right? Like, I actually had a CPA who's also a mortgage broker come in and speak to our team about the power that is just owning one home versus renting here in the Wasatch Front. And he had similar data, and basically with some very conservative assumptions, over a 35-year period, if you just owned one house versus rented for 35 years, the difference in net worth, in just net worth and cash flow, was almost $3 million. Buying an average home over a 35-year period, you buy it, you get a mortgage, you pay it off in 35 years was $3 million. And I was also reading another article that said, most people that are under 40 are needing at least $2 million to retire, right? And then, this CPA also extrapolated out like, hey, what's with the inflation at 3% a year, what is rent going to be in 35 years? And, the average house that rents for $2,500 a month today, in 35 years is going to rent, I'm going to pull this up so I don't butcher it. It was like just absolute craziness. It's going to rent for like $7,500 a month, right? So when you think about that, literally just think about this. If you bought one house, let's call it, you buy it a primary residency, and sometime in the next 35 years, you choose to buy a different house, moving up, moving out, moving whatever. You upgrade your lifestyle a little bit, and you just keep that one house. The tenants pay it off. Let's say you moved 5 years after you bought your first house, kept your first house as a rental, tenants pay it off. Well, in 35 years, if it's an average house in Utah that's currently renting for $2,500 a month today, in 35 years, it's going to be renting for $7,500 a month. Well, how many opportunities do you have that you can put a minimal amount of money in the stock market, and in 35 years, you're going to be receiving the equivalent of a six-figure income? There's none. I don't know of any. And even better, one that the tenants paid for that retirement plan, right? Like, I don't know of any. And if you know of one, I would love to hear about it, because I'm all in on that. That's why I buy rental properties. And that's why I think you too should buy rental properties. And why right now is arguably the best time that we will potentially see in a decade. And it could get worse. I don't think it will, though, because of a lot of different factors. And I only got into the tip of the iceberg here, and I want to keep this brief. But that's just a couple of reasons why I think right now we have this amazing opportunity right in front of us. And if you take action and you look for a good deal, and I'm not saying just go buy anything, right? Because prices could potentially go down a little bit more. So if you buy below market value today, really all you've done is you've just bought below market value. And if it goes down 10% a year for the next 2 years, but you bought today 20% under retail, well, you just basically bought that house 2 years in advance, right? As far as pricing goes. But you're getting the benefit of getting that loan paid down. And just like we never know when we're at the peak of the market until 90 days after, we never know when we've hit the bottom of the market until 90 to 180 days afterwards. We just won't, right? If you start, if I was drawing an imaginary line that was going down from left to right on like a graph, and I told you to tell me when we were hitting the bottom, and I just keep drawing, and then you, okay, Jordy, we're now at the bottom, and I just keep drawing down. Like, you don't know when you're at the bottom until you're past the bottom. So I don't know how long this window is going to be open. I'm super excited for this window, though. And I don't know how long, how short, how big. I don't know any of that. I just know the opportunity is here. I am prepared. I have been excited. I've been preparing for this for almost 10 years. And I hope you have too, and I hope you're able to take this information, make some financial moves that's going to set you up, and you're going to look back in 20 years and go, holy cow, I am glad I did, instead of looking back in 20 years and saying, man, I wish I had, right? So with that being said, guys, thank you very much for listening. I've now droned on for 24 minutes and 37 seconds. Thank you for your continued support. I am here on your march to financial freedom, wherever you're at in that journey. That's why I called it the Financially Free Investor Podcast. Not for me or anything. It was literally to help people become financially free. That's my hope for you. That's my hope for you and your friends, in fact. So please, if you found value in this episode, please share it with somebody that you think needs to hear this message right now. Maybe they read an article in Wall Street Journal that says it's a terrible time to buy. Well, there's opportunity in everything, friends. On your march to financial freedom, to doing more of what matters, to being with family more often, to not being a slave to a job for 60 years, barely to have enough money to squeak out ramen at dinner because inflation is crazy and the government doesn't really care about you or I, and Wall Street doesn't really care about you or I. My hope to you is that you can take this information and improve your life. I do this for free. There's no sponsors. It takes time. In fact, it takes resources. It costs me money every single month to put this podcast on. I do it for you. I do it for my posterity. I do it for my kids' friends, that one day maybe they can come across this information and not be stuck in the rat race for 40 years like we've been trained. So with that being said, friends, thank you. And I hope that your journey to financial freedom is absolutely fun, because we've only got one of them. Thank you for joining me for another episode of The Financially Free Investor. If you found value in this episode or know someone who would find value in this information, please share with them, subscribe, and send us a review.